All right, back to our main story, of course, today. Intercontinental Exchanges, or ICE's monthly mortgage monitor reports provide customers a glimpse of new trends across the housing sector. And according to the data, more than 300,000 mortgage refinances closed in September and October. That's the most in 2.5 years, according to the data, as borrowers took advantage of interest rates in the low 6% range earlier in the fall. Well, rates have inched a little bit higher since, but they do still remain well below where they stood during the summer. According to ICE Mortgage, the current 30-year mortgage rate sits at about 6.72%. Andy Walden, Vice President of Research and Analysis at Intercontinental Exchange and IMT, joins me now with more. Andy, great to see you this morning, and let's dive right in. Since the November jobs report released on Friday, traders are raising their bets that the Fed will move forward with a 0.25 percentage point cut in December. How does that impact your outlook on mortgages?
Yeah, the mortgage markets have loved that movement. There's also some geopolitical headlines that are pulling down mortgage rates as well. And so if you look at those 30-year rates over the last few weeks, they've come down by about 0.1%. And the same goes when you start to look at our futures data here at ICE as well. If you look at the futures for 30-year conforming mortgage rates, they anticipate rates coming down by about 30 basis points, a little over 0.25% between now and kind of the end of the spring home buying season. So some positive news here recently in terms of overall mortgage rates.
And what does the data show, Andy, regarding how rates have impacted prepayments on mortgages?
Yeah, we certainly saw those prepayment speeds up, especially in the month of October. They were up by about 1/3 from where they were in September. They were roughly double where they were last year and the highest in 2 years. And so as interest rates crept down near 6%, as you mentioned earlier, in August through September, you saw that speed up refinance activity. You saw that speed up prepayment activity out there in the market as well. Now, again, some of that's been pulled out of the market with higher interest rates, but it did give us a little bit of a taste of how the market will react if and when rates come back down near that 6% range again.
Are you finding that now is an attractive time for borrowers to refinance?
Yeah, it certainly was, right? You threw the number out there earlier. Over 300,000 borrowers refinanced their mortgages in September and October. That was a 2.5-year high. A lot of interest from folks that took out their mortgages in 2023 and 2024. We know the marry the home, date the rate mantra that a lot of those folks bought their homes with. They bought in anticipation of refinancing if and when rates fell. And as soon as we got a taste of that in August and September, you started to see some of that refinance activity flow into the market.
Any potential risks, though, when you look at the refinance market and the activity that we are seeing?
Yeah, I mean, when you look at the positives there, we saw some meaningful savings. We saw some cash flow improvement from those borrowers. The average mortgage holder that refinanced dropped their rate by 1.2%. They dropped their monthly payment by about $320 per month, which ranks among the 11 best average monthly improvements that we've seen. So some meaningful savings coming to those borrowers, some improvement in cash flows. In terms of the risks that you mentioned, loan to value ratios stand out, right? These are borrowers that have taken out their mortgage recently. Average borrower refinanced their loan within about 15 months of taking out that mortgage, which means that they didn't have a whole lot of time to see their home prices grow or to pay off a lot of debt between origination and when they refinanced that loan. They also refinanced funding fees, closing costs, interest rate buy downs, which in some cases pushed their balances above what their home is actually worth. And so when you look at overall rate term refinance activity for the month of October, about 10% of borrowers that refinanced actually wound up owing more than their home was worth, ever so slightly. When you look at some of the specialty markets, the Department of Veterans Affairs and VA loans, you saw over 1/3 of those loans wind up with a slightly underwater position, meaning they owe more than their home was worth post refinance. And so positive from a cash flow perspective, but when you look at their ability to sell in the near term here, they would need to bring some money to the table. If you look at some of those borrowers potentially struggling in the wake of these refinances, could impact loss mitigation opportunities and the outcome of those loss mitigation efforts as well. So certainly something to look at from a risk perspective.
When we look at the month of October, I know ICE's home price index was up 3%. What was behind that?
Yeah, that's a little bit of a shifting of gears in terms of that annual home price growth rate. We had been seeing it come down for 7 consecutive months. It went from over 6% back in February to 2.9% in September. As you mentioned, it took a slight leg up there in October. to plus 3%. Now, I think there's a couple of different reasons behind that. One of them is what we've been talking about. Mortgage rates came down in August and September, increased demand and put a little bit of pressure on price. That's part of the story. But some of this was a kind of a known phenomenon that was going to take place late this year as well. And the driver behind that is how soft the housing market got in the fourth quarter of last year, right? So those annual home price growth rates are simply where are home prices today? Where were they a year ago? And they were soft at this point a year ago. Interest rates had gotten up over 7.5%. They were threatening 8%. The housing market kind of shut down a little bit in the fourth quarter of last year. So that's making those year-over-year gains a little bit stronger and making it look a little bit more inflationary than it really is out there in the market right now. So if you look at how that could proceed here over the next few months, that means maybe we see a little bit of upward pressure in November, December this year as well before we start to see that annual home price growth rate ease as we move into next year. I look a little bit more at what's happening on the ground right now. October saw 0.2% seasonally adjusted monthly gains. You annualize that, we're talking more 2.5% growth right now in the market. So that suggests that after we see this upward price pressure in the fourth quarter, you could start to see those annual home price growth rates ease again as we get into early 2025.
All right, Andy Walden, Vice President of Research and Analysis at Intercontinental Exchange and ICE Mortgage Technology. Andy, always great to see you. Thank you so much.
You bet. Thanks, Kristen.